Hi, my name's Derek Carmichael of PwC Global Accounting Consulting Services. IFRS 16 Leases was published in January of this year. With the standard having been released for a number of months, we thought it would be good to review how companies are progressing in their preparations for implementation. It's also an opportunity to take a look at some practical questions being asked on how to apply some of the requirements of the standard. Today, I'm joined by Jay Tata from our Accounting Advisory Services Group and Jessica Torre of the UK Accounting Consulting Services team. Jay, it seems that the new standard will have a major impact on a number of different industries.
Yeah, that's correct, Derek. So our global lease capitalization study, in which we've analyzed over 3,000 IFRS reporters, shows differing impacts by industry. For example, we see that retail is one of the industries with the largest impact. Debt loads will double and EBITDA will increase on a median level by 41%. That's obviously because this industry is a heavy user of off-balance sheet property leases today. Now, the second industry in line that will see a large impact is airlines. And airlines obviously has quite a few off-balance sheet aircraft leases today, which is one of the reasons why we actually have this standard. And some of the other significantly impacted industries include healthcare, transport and logistics, and telecoms.
Thanks, Jay. Jessica, one area some companies are finding challenging when measuring the lease liability is identifying the appropriate discount rate. What guidance does the standard give us here?
Yeah, so the standard says that in theory you're supposed to use the rate implicit in the lease. The rate implicit in the lease is the rate that causes essentially the present value of the lease payments plus the residual value of the asset to equate to the fair value of the underlying asset plus the lessor's costs. And as you can see, there's quite a lot of components involved in determining that number, which aren't always apparent to lessees. So therefore, the standard does allow lessees to use their incremental borrowing rate instead.
And there are some rules around identifying this rate as well.
Yeah, so the incremental borrowing rate is essentially the rate at which lessees could borrow to acquire the right-of-use asset. So not the entire underlying asset, but just for their right-of-use portion. And that needs to take into consideration the collateral as well as the credit standing of the entity.
It sounds complex. Jay, what sources of information are companies using when identifying the discount rate?
Well, the incremental borrowing rate is obviously the easiest starting point for a lot of lessees. But with the low interest rate environment that we have today, a lot of lessees are concerned that this will significantly increase the amount of lease liabilities they record on balance sheet. So they would rather use the implicit rate in the lease. So they're looking to their lessors to provide them with the implicit rate in the lease, or for property leases, they look to use property yields. Now, there's quite a few challenges around determining the implicit rate in the lease. And even if they're able to obtain this information from lessors, or they're able to determine the property yields for all of their leased properties, for example, for property yields, it has to be a specific rate based on the underlying lease contract. So many companies will have to make adjustments to make the property yield specific to the lease contract as required by the standard. And for this, they will often need their real estate department, their treasury department, or external experts to actually make some of these adjustments, because it is a complex exercise.
Sure. Thanks, Jay. Jessica, one other aspect both lessors and lessees need to consider is identifying the lease term to use when measuring the lease liability, because obviously that affects the lease payments that are included within that calculation. What does the standard tell us here?
So the standard says that the lease term is really what's enforceable under the contract, but it also asks you to consider things like extension or renewal options, as well as break clauses, to the extent that the lessee would be reasonably certain to exercise them.
How does a lessee identify whether something's reasonably certain?
Well, it's going to be a challenging decision, I think, but it should reflect the economics. So things like what's the current lease term under the contract in terms of how much are they paying for that rent versus what they could do if they moved out and had market rent from somewhere else. Things like, have they made significant leasehold improvements and other costs like that to take into consideration.
It sounds like there's a lot to consider. Jay, what approaches have you seen companies take to making this assessment?
Well, many companies find this quite challenging to apply, particularly how to weigh the different factors in IFRS 16. So, for example, a relocation of any asset or entering into a new lease will involve certain costs. So would that mean that a renewal option is reasonably certain of being exercised? Or, for example, a company may look at its past practice and see that they've leased assets on average for 10 years. Does that then mean that reasonably certain lease term will end up around 10 years? Now, this lease term judgment is extremely important because it has such huge impact on how much lease liabilities company record on balance sheet and has much more impact than the discount rate. And the practical challenge for a lot of companies is often within the accounting departments, they don't have all the information necessary to make this judgment. So they'll need people from the business. They'll need to understand some of the economic reasons behind these leases to be able to make that judgment. So they'll need people in their real estate department or other people in the business to make that judgments. And I wouldn't be surprised if at the end of the day, some companies end up with larger amounts of lease liabilities recorded on balance sheet because of this judgment compared to what they're disclosing today.
Determining the lease liability does seem like a very complicated process with a number of key judgments to make. As companies prepare for transition, does the standard provide any relief?
It does, actually. One of the first reliefs is whether you have a lease or not in the first place. So to the extent you determine something wasn't a lease under IAS 17, that remains grandfathered and you don't need to reassess that when you move to IFRS 16. The other simplification is that whilst the standard says you could choose to do fully retrospective application, it does allow a more simplified, modified method.
How does the simplified approach work for leases which were previously operating leases?
So essentially it allows entities to consider what their remaining future lease payments are and discount that using the incremental borrowing rate at the date of transition rather than having to go back and retrospectively determine what that number was. And in terms of the asset, well, it allows you to equate that to the value of the liability, or you could choose to retrospectively figure that out. But in terms of its discounted amount, it would also be determined using the lessee's incremental borrowing rate at the date of transition.
And the standard also provides a simplified approach for leases which were previously finance leases.
Yeah, that's the easiest one. You can just use the same carrying value from IAS 17 and use that for IFRS 16 going forward.
The simplified approach sounds very helpful. Jay, what factors have you seen companies considering when deciding which approach to take?
Yeah, so the simplified approach is definitely the easiest approach to apply. So the project teams that I often speak to tend towards the simplified approach. But then when they have conversations with their CFO or with their board, they're more concerned about comparability because they have to explain this change to the investors and other stakeholders. So a lot of companies will have to think carefully about the transition approach they go for, and it will always be a balance between the effort that is involved and the needs of all stakeholders. Now, once they've determined the transition approach, a company has to prepare a roadmap working backwards from the adoption date. And for many companies, that will include a couple of elements which will always be similar. For example, setting up a project team, gathering all your lease data and defining your lease population, implementing an IT solution, and redesigning some of the processing controls and reporting around leases. Now, many companies that prepare this roadmap and work backwards from the adoption date, when they take out all the blackout periods related to quarterly and annual reporting, budgeting obligations, and other priorities that they have, then they realize they don't have much time left to actually work on this implementation. So I would advise companies that haven't started yet to start with the implementation as soon as possible.
Sure. Thanks, Jay, and thanks, Jessica. Hopefully that provides you with a flavour of the challenges companies are facing as they look to implement the new standard. Applying IFRS 16 is clearly going to have a significant impact for many, not just from an accounting perspective, but also systems, processes, and communication. For more guidance on the challenges faced and on how we can help, please get in touch with your local PwC contact. Thanks for watching.